or any other business which we think about. Now, what is the investment strategy in the next 2 years in Indian stock market? The present scenario, I will divide into four. One is COVID-19, drop in oil price, international event, and national events. Now, COVID-19 is the first thing which I'll discuss. Lockdown for 90 days and further extension is expected. Reduce in the government collection except like GST collection, which is around 30,000 crore as compared to 90,000 crore per month in the last financial year. Business will open slowly and don't expect V or U-shaped recovery. Will take at least 3 months to recover and that to be very slowly. Automobile, aviation, hotel industry, restaurants, just 1 minute, 1 minute. Sorry, I was alone at home and somebody came. Anyway, so the automobile, aviation, hotel industry, restaurants, movie theater will take a very long time to recover. Digital platform like Netflix, Prime Video, all these things will gain significantly. One company which I've invested in this last year is Silly Monk, which is from the South, digital-based company. They are regularly giving dividend as well as they have given the bonus last year, 5:4. Survival is the first mantra. People are not going to have a luxury in the beginning. So my mantra for next 2 years, at least for 6 months, roti, kapra and makan. Makan is something which is difficult, but roti and kapra will be the priority to survive. Now the second international factor which has occurred is drop in the oil price. Now for the first time after almost 50 years, we have something which is there in our favor. We are always paying the large amount of foreign exchange in importing the oil. We are almost nearly grossly dependent on imported oil. For the first time after dropping the oil price to $30 per barrel, which will remain probably the same for next 2 years, we will save 3.5 lakh crores per year. This is something which is very positive for us because the money will remain in the country. And because of the drop in the oil price, the end user of the oil and its product will be benefited significantly, like polyester fiber, chemical industry, API, etc. Drop in the oil price will create severe economic distress in certain countries like Canada, Norway, USA, Saudi. So the demand will reduce in their country and the export will suffer from us. Refining margins also will reduce significantly. So avoid the refining company like IOC, BPCL, HPCL. Even the ONGC and Ceylon exploration will not have so much of earning this year because of drop in oil price. Even though the drop in oil price, the government has not reduced the petrol or diesel prices. In fact, they increased the excise duty. So the money which was supposed to go to the refinery company has been taken over by the government. The electric car launch will be delayed further because the difference between the petrol and the lithium battery will be reduced drastically, and hence those who are there in this industry, one should avoid them like Indoborex and Panasonic Energy. Since our oil import consumes major foreign exchange, in the oil price, we will be saving a lot of foreign exchange and rupee is very unlikely to depreciate further. The international event is major shift in the sentiment against the China. World over, especially Australia, Europe, New Zealand, Japan, UK, they already declared that they want to shift the production from China to their own country or some other country. India will be biggest beneficiary because of its size as compared to Vietnam and Bangladesh. Large number of manufacturing units might shift to India, and our relation developed by Prime Minister in last 6 years will help us. The present government must change its approach from socialism, which is there today, to a capitalism so that we do not lose this opportunity. All are scared of China because they are likely to take advantage of valuation of all the companies which is so low. And hence, many companies have stopped Chinese people to buy the shares of the company. Deglobalization is going to be a next 5 years of mantra, which I told last two years back in BOA, one of the conferences. And once they develop their own productions, it takes about 2 to 3 years. And the gap will be filled by us, especially in chemical, API and pharma industry. Dollar will mostly lose its reserve status. What has happened is Nixon has created a petrodollar type of situation. And therefore, so many years, we have to pay only in dollars to buy the crude oil. And now China and other countries started a barter system to avoid the dominance of dollar. Due to currency uncertainty, whether the dollar will remain or not, gold and silver will become a safe investment at present, even though the prices are very high. Silver probably is much better than the gold because silver is not produced and silver is used in many industries at present. There is a remote possibility that USA may block China's reserve in USA against the super for COVID-19 compensation. China will have a lot of problems because they have overproductions, lack of export, boycott from many countries, communist regime and no transparency. To that they have added the problem with Hong Kong now. All these factors will help our government to get the maximum advantage for us, provided they change their approach. The internal factor is excess of liquidity is there in the bank. Has forced government to reduce the interest rate to 4% on FD, which was declared, I think, 2 days back. Government got 7 lakh crore instead of 3.5 lakh crores by way of various repo rate. Those who do not got the repo rates is the one in which when you deposit the money in the bank, either in the savings account, fixed deposit or any other way, a small portion of this money is taken away by RBI in order to control the fluctuation of the foreign exchange. And that is known as a repo. They were expecting 3.5 lakh crores. Instead of that, the bank have given them 7 lakh crore because they could not utilize the money which they have. The other thing is most of the Indian company wants to return the money and reduce the debt. As we've seen in Reliance industry recently, they're likely to return 1 lakh crore rupees by the end of this year. Various things are announced by the government, which will be implemented slowly, and that will be aimed to win the next general elections. The internal factor, the other one, a huge foreign exchange reserve. Even though a lot of money has been, lot of selling is done by the foreign investors, especially Norwegian fund, which was holding $1 trillion world over, and they have sold a lot of shares all over the world, and that's why from March till May beginning, you saw almost 1,000 points going down every second day. What has happened in Norway, that they were running the country because of the oil price. Now, since the oil price has collapsed, they could not run the country. That's why they're selling the assets all world over. We have a relatively a strong leader as compared to the previous one. So if he wants it, he can implement changes very fast. Corporate tax also in last budget has been reduced to 25% and will help the taxing companies to save a lot of money, and that will be one of the factors to decide which shares we want to buy. Now, once you decided to invest in India, then which company and which sectors you are likely to invest. When you select a company, as far as the country is concerned, the lowest per capita debt amongst the large economy as compared to USA and Japan. Lowest damage of human life in COVID-19. You will have a 6 months painful economy till the December, still after which probably the revival will start. The government has given 20 lakh crores of package, even though they have not given direct money to anybody, but they have given a lot of guarantees which will help the MSME to survive, to maintain the jobs of the country. There is an anti-China sentiment which will help us. There is a huge saving due to drop in the oil price. Rural economy to get the maximum attention because in last 5 to 7 years, we have hardly any investment done in a rural economy. Before the next elections, our Prime Minister wants to increase the farmer income to double. Now, once you decided, you have to select the company and the sector. I always prefer to go for small and mid-cap companies, which has got a low valuation at present, nearly zero debt, high percentage of management holding, making good profit and expansion without borrowing the money, low price earning ratio and high dividend paying, will sail through this difficult time without any problem and they have increased their personal holding in last 3 to 4 months time. Which are the sectors which are very positive for next 6 months to probably 2 years. So when you select these things, you must understand that which industry is benefited in a coming events. So the first event is reducing the oil price. So there are so many industries which are using this oil and oil product. So their production cost will go down because the raw material cost has gone down. The polyester manufacturing fibers, the polyester fiber manufacturing industries, they will be benefited significantly. Amongst the company is Century Enka, Indorama Synthetic, SRF and Filatex. Now I'll take one example. This is not the recommendation, but this is how we select once you decided the sector. Now Century Enka is one company which is quite favorite as far as I'm concerned. It's a debt-free company from Aditya Birla Group. Its price earning ratio is 3.5. Those who do not understand about the price earning is that suppose the equity of the company is 20 crores and they are making a profit of about 80 crores. So price earning ratio is the number of shares. That means 20 crores divided by 10 means 2 crore shares. And then you divide 80 crores divided by 2, that comes to 40 rupees earning per share. They are paying 70% dividend and the price value of the share is 130. So it gives an yield of 5.3% even today, which the bank is also not giving. It has paid 40 crores of tax last year. So if you are saving 20% of this because the tax rate is reduced, that will add to the profit this year. The net value of the company with the land, machinery, the reserve, the bank balance, everything you consider and a depreciation is approximately 1200 crores as compared to the market value of the company at present is only 250 crores. So you are getting a share which is at 1/4 of the price, the net value of the company. So this is how you select the company when you decide about investing in any company. Same Century Enka, last year gross profit after the tax was 120 crores. The raw material prices dropped by 60%. Will reduce the production cost at least by 40%, which is a huge saving. The price of the polyester fiber also has dropped down, not that it is not dropped down. An expected net profit next year or probably after that should be 200 crores with earning per share at approximately 100 rupees. All other companies like SRF, Filatex and Indorama Synthetic will follow the same pattern. I have bought these shares last time 2008, when the oil prices collapsed from $140 to $30. The price of Century Enka went up from 80 rupees to 320 rupees. The same pattern probably follow this year because the oil price has dropped down. Remember, the world has not come to an end. There will be a maximum opportunity whenever everybody is selling it off. Now, the second factor where we decide which sector and which shares you buy is the government policy. Now, government has announced that they want to increase the farmer income at least by double, and they will definitely do it before the next elections. So to do that thing, the biggest problem they had is that electricity subsidy, which they cannot afford to do anymore now. So they have to make them self-reliant as far as the electricity is concerned and water supply. So what they decided is that they are going to give 30 lakh solar pump for farmers in next 2 to 3 years time. Even Maharashtra government has allotted 95,000 crore for the same. The government of India has also allotted 4 to 5 lakh crores over a period of next 3 to 4 years. Second thing is they want to give everybody water connection in the house, like what they did for toilet as well as for the gas connections. They did the same thing. And when they declared these gas connections, I had purchased confidential petroleum and I purchased at 7 rupees and we sold it at 50 rupees. The water purification and desalination is very important for us because we do not have so many rivers to supply the water in every house. So we'll be using a 4,500 kilometers of coastal land where we'll desalinate this water and supply it to everybody's house. So the companies like Ion Exchange and Vatek Webeg are likely to get benefited. Now, one company which is very important and I like this company and I have invested in a big way is SHAKTI Pump. This is the only integrated plant for solar pump. It has capacity of 70,000 pumps per year. At present, it is utilizing only 40% of the capacity utilized. Registered supplier with government. So they have always cleared all the clearance and they are registered. So the moment they get the order, they can supply it. Funds are already allotted in budget, plus 1 lakh crore is additional given in a rural economy infra recently during this COVID-19. 30% subsidy is given by each center as well as the state. That means suppose a farmer is buying a pump at 2 lakh rupees, 30%, that means 60,000 is paid by the state government, 60,000 is paid by central government, and only 40% is to be paid by the farmer. They also, 40% is given to them as a concessional interest rate of 4%, and they can return this money without doing anything in 1 year. They will have an income of generation of electricity in a non-farming time. That means they have a farming time of 180 days and rest of the time they do not do farming activity. So during that time, the power is generated and it is sold to the central grid for which they will get the money. So even if you consider one single year, they will be able to return the 40% which they are paying it. Second thing is after 1 year, once the guarantee period is over, SHAKTI Pump will have a maintenance cost and they will have an income from maintenance contract throughout. So this is like a software company who installs the software and to maintain, again, they will continue to earn the money. So this is one thing which probably I like this quite a lot and I'm almost holding 1% in this company. The other sectors are, which are at present, the second one is kapda, roti kapda. Now we consider kapda as Vardhman Spinning, Rajasthan Spinning Mill, Loyal Textile, Ambika Cotton, Welspun India and Trident. Amongst them, I think Ambika Cotton is the best of the lot. It has got 100 rupees earning per share, 160% dividend, debt-free company, small equity of 5 crores, and they always pay dividend more than 100%. It is available at 5 PE ratio, and it is one of the best cotton manufacturer in India. Those who are buying the shirts of 20,000 or 30,000 branded shares, the cotton comes from Ambika Cotton. The second part is the agriculture. Agriculture, because of COVID, many people will shift from non-veg to veg. And even if the 5% of the people shift from non-veg to veg, the most common vegetarian food eaten world over is rice. You can imagine the amount of demand the rice will have. Recently, WHO and even the United Nations has told them to remove all the conflict. And if that is done, the sanction against the Iran will go. And this company, rice manufacturing company, will have a good time because they were all held up because of these sanctions. Amongst the best of the companies is KRBL and Sarvesra Food. Sarvesra Food is Kashmir-based company, small company, 7 crores equity. And they have I think 17 or 7 crore equity. They have a 700 crore turnover and 700 acre jameen, the land. And it is available at throwaway price of only 14 rupees. I have purchased the share at 10 rupees. I also hold 1% in this company. Second sector is telecom, in which Airtel and Vodafone, because we are going to go for a 5G and all the things are getting digitalized. Telecom is going to have a wonderful time in next 3 to 4 years. And we will be probably leader in 5G technology because most of the people are now against China. So government has already initiated to start the 5G. And one of the best script which I have taken at rupees 3.25 is Vodafone. I think Hemalini Sawant probably knows about it because we are working together and I have told her also about the Vodafone. The second one is when you are going to distribute the pipe all over the country, the water supply at home, the pipe manufacturing also will have a good time. Amongst them, Jindal Saw, Maharashtra Seamless, Sri Kalahasti Pipe and Skyper. Again, Skyper, I am holding a percentage. The other factors which are there, whenever, suppose you don't like any of these and you want to invest somewhere else, I think any company which has got a good balance sheet and which can withstand for next year, I think you should go for it. At least you will get 30 to 40% return in 1 year's time. So which are these companies? Any company with a good balance sheet, go for it. All the good companies are available at throwaway price. DHFL is one thing. I know everybody might be surprised, but I have bet big in DHFL. Kanchi Kapooram, Gujarat Themis. Gujarat Themis is one thing where the rifampicin prices become 300% more than last year. One of the favorite is IOL chemical which manufactures ibuprofen. I have purchased at 200 rupees in the first week of March, and today it is 400 rupees. VINDHYA TELELINK, again Aditya Birla. I'll show the balance sheet how to read this after this. Vodafone, Welspun Gujarat, again it's a pipe manufacturing company. Nahar Spinning, Ludlow Jute and Cheviot. These two companies are in a jute manufacturing company, and one day the government will definitely ban the plastic. 100%. Cheviot is another company which is a very cash-rich company. They have paid 58 rupees dividend on 10 rupees shares. I had purchased at 400 rupees. I sold it at 1700. Again, I purchased at 450 rupees. It has got 100 rupees earning per share and paid 58 rupees dividend before 31st of March. See, Rayalaseema Hypo is another company with the only manufacturing country of hypochloride, which is used for purification of the water. These are the companies which has got a great potential. There might be many more you can search. Invest for 2 to 3 years. Don't see the prices daily. Forget for 2 years as if these monies are not yours and you don't need this money, and you will see the maximum advantage you will get it. Now, this is one company I'm going to give you an example is Kanchi Kapooram. The company has reduced the debt. Company has reduced the debt. Company is virtually debt-free. Stock is trading at 1.06 times of its book value. Company is a very good consistent profit making of 60.13%. I think this is a fantastic over last 5 years. I had purchased this share at 25 rupees and I sold it at 350 rupees. I added these shares at 175 rupees in last 3 days. Company has a good return on equity, a track record of in last 3 years, and it has got 49.52%. All these data are available on the net. You need not depend on me or anybody. And promoter has increased his stake by 1.70, which is a significantly good. Now, this is how you read the balance sheet. If you see from March 2010 to March 2019, the company's turnover, which was 29 crore, has grown to 188 crores. And they have come out with, see, they hardly pay any interest. So they are almost debt-free company. The operating margin, which was 24%, has increased to 24%, 12% to 24%. The only negative factor is they have never done any expansion. That's why the depreciation is hardly anything. They are the chemical manufacturing industry and they are paying good amount of tax. Last year, they paid 31% of the tax, which will be reduced to 25% this year. So they will be saving the money and the net profit has grown up from 1 crore to 28 crore, which is fantastic. And EPS is 67 rupees today and price is 175. The other company which I was telling you, again, you have to find out how to learn this. You have to learn these things rather than depend on anybody. The VINDHYA TELELINK is belonging to Aditya Birla Group. It's a belonging to Birla Group. The market cap is 691 crores. The current price is 583. The highest was 1538 last year. I bought it, these shares at 370. Book value is 2044. The stock P ratio is 2.4. Dividend with 500 rupees also is 2.06. That means they are paying almost 120% dividend. Return on capital is 15%. Return on equity is 12%. Sales growth for last 3 years is 27.28. Why do I select this company? Because you need to have a large amount of optical cable. If you want to have a 5G network, you need 25 times more fiber network installation over the 4G. So you can imagine the amount of demand this company will be having in next 5 years' time. You see the balance sheet. You read the balance sheet. This is also available on the net. The share capital has been maintained throughout up to 12 crores only. The reserve has grown up. See, from 230 crores, it has gone up to 1600 crores. I can't see because of the the screen which is coming in the way. I don't know how to do that. Anyway, the only negative factor in this company is that they have borrowed the money and their own reserve has been kept for the investment. I don't know why that. But this is the way you can learn the whole thing. This is all available. Suppose somebody wants to learn all these things. No? There is a website called screener.in. Please write down. Don't forget this. Screener.in, and you will get all the data, their analysis, everything is there. So nobody can cheat you. Now, which are the sectors you should avoid it? The entertainment like movie theaters like Inox and PVR, auto and auto ancillary because they are going to pass through a difficult time, home finance company and NBFC because you don't know what they are going to have the business or not. Public sector banks I would avoid because how many NPAs are still pending, nobody knows. You can go for private sector bank, and I like the best of the lot and the very cheap share is IndusInd Bank. Any high debt company, you should avoid it, like Anil Ambani's company. Huge management shareholding, which is placed to the bank. Tours and travel, please avoid them because nobody is going to travel even if they open out. Aviation should be not do anything for next 6 months. After 6 months, if you want, you can buy the Indigo shares. Refinery shares, I already say, real estate is in a very difficult situation. Luxury goods, nobody is going to buy in the first 3 to 6 months time. Home appliances, AC, all these things will take 6 months to buy. Oil exploration company, again, because the oil prices drop down, they will not do well. Thank you all for patience hearing. I am not a registered SEBI fund advisor. Ask your financial advisor if you before buying it. The lecture is to educate, is for education purpose. You are not responsible for your profit and loss. Please do remember, for any delegates after hearing this lecture, I hope all of you will make good amount of money in this difficult time. Thank you so much.
Thank you, Ramesh sir, for a very enlightening talk. Should we take the questions later or right now?
That's your choice. Whatever way you want, because we have enough time now.
I think we'll take 1 or 2 questions and then we'll move ahead.
Okay.
Dr. Mitesh is asking, what is the holding time we are looking at right now?
Yeah. Whenever I buy the shares, I always buy for 2-3 years. And it has always given me wonderful. I'll give you 1 or 2 examples. We purchased Aban Lloyd for the first time and I kept it for 3-4 years. All my friends have sold out. When they made the profit from 50 rupees to 150 rupees, they all sold out. I did not sell them. And I waited, I started selling after 1,500. And the last sale, I sold it at 25,000, from 50 rupees to 25,000. Not that all the shares are sold at 25,000, but I started selling after 1,500. Second script, which is also similar to that, is KRBL, from 25 rupees to 12,500 rupees. So you have to sell slowly. It is everybody's appetite to take the risk. Somebody is very happy with 15-20 rupees. The biggest problem we have is we do not book the losses. We always book the profit early. So 2 to 3 years, I think you should always think. And if you keep 2 to 3 years of horizon, you do make a good money out of it.
There is one more question from Dr. Kamal Dedia. What is your opinion for non-banking finance companies like Bajaj Finance, L&T Finance? Should one invest or wait?
I would say the L&T Finance is better. Even Bajaj Finance is good, but the Bajaj Finance is the biggest. The retail financing, I don't know how long it will take to revive. The Bajaj Finance probably no, but L&T Finance is very attractive at near 50 rupees. Okay. L&T Finance looks quite attractive to me.
Okay, Dr. Janak Shah is asking, what is your take on fishery stocks? For example, Avanti Feeds, PE 21, equity 13 crores, dividend 500%.
Now, this Avanti Feed again is a wonderful company. We have purchased 10 rupees share at 68 rupees some 6-7 years back. And it went to 2,500 rupees, 2 rupees shares. See the type of, normally when I buy a share and if I am sold out, I never repurchase that share again. Because the best of the time every company gets once in lifetime. It never gets repeated. So from 500 to 10,000 is very difficult. That is what my aim is. We don't want 500 to 700. No. Once I sell out their shares, once I purchase it. Similarly, Venki was one thing. We purchased at 50 rupees, 10 rupees shares, and it went to 2,500. So if somebody tells me to buy a Venki again, I will not buy it. I'll go to the other script. But it's still a very good company, Avanti.
Okay. One last question before moving on. From Dr. Anjana Shah, is it not good to buy Nifty rather than individual stocks?
I have no idea about the Nifty. I always believe that I will select the shares will become Tata within the next 5 years. I don't want to buy Tata now because Tata is already grown up. We want somebody who is growing up. Similarly, we had this Praj industry. When the government liberalized the sugar industry, we bought the Praj industry at I think 80 rupees and it went to 1800 rupees. So we are searching new Tatas and new Birlas and new Ambanis. And most of I have never purchased, most of the time I never purchase A group shares. I have always purchased B group, small cap and mid cap. I have always seen the asset also of the company. There is one company which I recently bought was MacLeod Russell. It's a largest company. They made a fraud of 1300 crores. I bought it at 1 rupee and 60 paisa. It has dropped down from 650 to 1 rupee 60 paisa. I bought it at 1 rupee 60 paisa. I sold partially at 5 rupees in 3 months. So 1 rupee 60 paisa, 3 times money in 3 months. And you can sell it in bulk also. There is no problem with it.
A question relevant to us. What about the pharma industry, investing in pharma industry and investing in vaccine making companies right now?
Vaccine making company, if they find out any vaccine, sky is the limit. But if you don't find it, I don't know where will you go. Serum Institute of India is one of them. But I would say that you go for API, the active pharmaceutical ingredient, like IOL chemical, granules. There are so many. And these companies, I think one of the favorite company, I think Berger has also told me, is about the nozzle, because they also have an advantage of falling price of the oil. The only problem with nozzle is that they have applied for anti-dumping duty against certain products. Once that clears out, I think nozzle should be a good bet. The only problem with nozzle today is 160 crore is the equity, which I usually don't like such a big equity. I always prefer to have a small equity.
So there are a few more questions. We'll come back later. I would request Dr. Manoj Agarwal sir to start his presentation. Ramesh sir, can you stop? Yeah.
I already stopped.
Yeah.
Swapnish, can everybody hear me?
Preetham sir, I'll just unmute you.
Yeah. Swapnish, am I audible?
Yes, sir. We can hear you.
Okay, so how do I get the PowerPoint on SHS first, please?
So your voice is a little muffled. Is
it okay now?
Yeah, much better now.
Okay, I'm holding it closer. Should I go to share screen now?
Yeah, please share your screen.
Yeah.
Huh?
Yeah. Is my screen visible to you all?
Yes, we can see you.
Good enough?
Yes.
Okay.
We can see your screen.
Am I clear now? Screen is okay? Can I continue?
Voice could be better.
Yeah, voice is.
Is it better now?
Yeah, correct.
Okay,
now it's better.
Okay, so I'm holding it next to my lips only now. Okay, so good evening, everybody. I would like to thank Preetham, Swapnish for giving me this opportunity on behalf of VA to give you a talk on mutual funds. My point of view was that I'll try to give you an overview of mutual funds, starting from what is it, how to go about it, what are the types, what you should do, not.
Manoj sir.
Yeah.
There are a lot of messages coming on the chat regarding the voice quality.
One second.
Do you have a different headphone? Try using a different earphone.
Okay. Just give me a second. Just give me a second.
Sir, there were too many people coming in and going out of the meeting. So,
okay.
How's this? Is this better?
Yes, now it's better.
Okay, I've changed from the another one to a Sony headphone. So this is that I'll stick to this one. Okay, so what I'm going to do is I'm going to give you basically a brief overview of mutual funds, starting with what are they, how to go about, types, what you should do, how to think about investing, and etc. etc. So should we start? Okay. As obviously I'm an ophthalmologist like all of us, I don't have any financial qualification, so please excuse for that. This is Sri Dhirendra Kumar. I'm a big fan of his.
Sir, Manoj,
And
sir,
yeah.
Manoj, sir, we are again having a lot of
Audio problems.
messages saying that voice is not clear.
Okay, just give me a minute. Just give me a minute.
Can we go on to Ryan's talk and then come back to you?
Okay, let's do that. Let's do that.
Yeah.
Let's do that.
Yeah.
Okay.
Okay. So,
Manoj sir, can you stop your screen? Manoj sir. Okay, I'll do that. Yeah.
Yeah. Ryan, you're ready?
Yeah, I'm ready. Can you hear me?
Yes.
Yes, clearly? Okay, fantastic. Let me just share one of my screens.
I just unmute Senior Banaji sir also.
Yes.
Give me a moment. Can everybody hear me? See my screen?
Absolutely.
Yeah.
You're loud and clear. We can see you.
Perfect. I've got the little professional mic set up. That's why. Just to introduce myself, it's become fairly obvious. Yes, I'm Dr. Banaji's son. And no, I did not choose to become an eye doctor, even though there are a few generations behind me. But I chose to go into the markets. Came back from New York, where I was working a finance job with a company called Honeywell. And that was all for the internal finance. I had no ideas about the markets about 8 years ago. All I would know is things going green and red on CNBC. That's really about it. But I've been doing this for a few years now. Yes, I was actively consulting with OTA for some time, and then chose to move to Portugal because through that I have access to the global markets, and I wanted to sort of dip my toes into those as well. So anyway, the talk, it's equities, a reality check. So I'm not here to debate systems or anything. I have a fairly dispassionate view about the market, and I'll give you an idea of what somebody who does this for a living, perhaps I'm going to be definitely the contrarian over here, a contrarian way of thinking about it. Okay, so let's just talk a little about psychology and mindset. So what is the market? Anything. By market, I mean the Nifty, any company you could talk about right now. Let's say, I don't know, Axis Bank. What really is that? The market itself, the charts that you see, the news that you hear about price moving up and down, it is completely neutral. All it shows us is people buying and selling. How we choose to react to it remains our choice, right? Some people are saying, okay, I find value at this price. Other people say, no, I'm definitely getting out of the market. But the market is basically a mirror of your strengths and weaknesses, how you to choose to trade it, whether it's aggressively, conservatively, out of fear or out of greed. It'll bring out the worst in you at times. If the market, this is a thing that I keep on hearing about, oh, the market has taken my money away from me, I'm going to revenge trade against the market. The market doesn't know who you are. It's just an aggregate of price. It's a consensus of people finding value. If the market doesn't want to take revenge on you, why would you want to take revenge on the market, right? So the whole idea of revenge trading, definitely don't think about it. Any loss that you face, it should be dispassionate. If I make money on one trade or I lose on the other trade, in fact, I think of my losers as, yes, I'm out of this because I'm not going to lose any more money. It's a positive thing for me. Are people who do this for a living emotionless? No, not at all. There are emotions. So while the whole COVID crisis was going on, the most volatile markets I have ever seen, and at the end of March, strong buy signals came, and I pulled the trigger on March 25th, I believe. I pulled the trigger on a lot of stocks and bought. while the news was at its worst and everything was panic. And the markets have recovered a fair bit from there. So do I feel fear at times? Yes. But then another thing is you have to reflect and think about is it what you feel, or is it what is really what the market is telling you? What separates, let's say, quote unquote, a professional who somebody does this for a living is that they have a very strict rule set. And they know exactly when they're willing to get in of the market and, most importantly, out of the market, whether that be for a loss or profit. The execution will also come without any hesitation, reservation, or fear. Okay. The other thing is acceptance. Trading, investing, all of this, you need to know when the odds are in your favor. And I'm not the most mathematically astute person in the world, but I know when I have probabilities in my favor. Okay, market is all about probabilities. Let's say you choose two companies on whatever basis that is. It could be a technical analysis thing, which is, let's say, moving averages, or it could be on fundamentals of a sector that you have researched. One stock can do very well, one stock can do terribly. You don't know. That is because probabilities are based on the fact that you may execute exactly the same way, but the sequence of which you go right to wrong is completely unpredictable. What you have to think about is here, if I trust my system and I trust myself for the research that I've done, have the very generic term of, cliche term of have conviction, sit through it, and then trade. So unfortunately, I'm going to tell you something. Doctors and engineers make some of the worst traders. They're the most difficult because it's your whole profession is predicated on being right and knowing the exact little details here and there about everything. So it's pretty tough to teach them, especially including my dad, who just could not let go of the fact of a stock had given him money, but he wanted to stay in for the big move, or he couldn't accept the loss that he was taking. Compounded bad news for men, women are better traders than us statistically. They have less of an ego. Okay? So, but people who make very good, that doesn't mean doctors can't become good traders. Don't get me wrong. I think doctors can become phenomenal traders because of work ethic and an eye for detail. And I don't mean just trading. I'm saying it as a generic term in the case of investing also, like anything, any interactions with the market. People who make very good traders and investors are pilots because they are regimented every time before they take off in a plane. They will have a checklist, etc. There's studies done in Arizona as part of the organization that I was done, where there were a lot of pilots from the Phoenix airport that became phenomenal traders because it was like instinct to them. Follow the rules, and that is it. So basically, the best traders in the world are definitely going to be female pilots. So I think we're all in trouble otherwise. And more than anything else, what you need to realize is you need to be yourself. Because at the end of the day, whatever your trading style is, just because you've learned, let's say, a new technical system, or you have thought about staying in stocks for longer or investments for longer, if it's not part of your internal fiber of being, of how you interact with the market, nobody else is going to judge you. Okay, you need to learn to be your own edge and have complete faith in it. Okay, these are a couple of things of uncommon knowledge, the way, let's say, a contrarian trader investor like me would think. It's okay. The golden question that everybody keeps on asking is, when will price turn? And the answer is okay, when everybody sells or buys. Okay, but listen to the logic behind that. Even like Dr. Shah said, the best opportunities come when everybody is selling. Okay, why? So the logic behind that is this. If there's so much panic in the market and people have written off companies and aren't willing to put in capital, everybody is bearish. If everybody is already sold, are the only people left in the market? The buyers, right? And when there's such few sellers, the way a market works is, as buyers step in, it'll move to the next price point of where sellers are sitting. So what happened to the Nifty at the end of March? At the end of March, everybody was so bearish and only a few buyers were left in the market. How you find these points, that's up to you, whether it's through fundamentals, whether it's through technicals, however it is. And in the same way, when the markets go up and everybody's bullish on the market, okay, when everybody's buys and sitting on greed, okay, and they're making money, then who's left in the market when people book profits, or the earliest people who realize when the market is going to turn? It's counterintuitive, but that's the way the markets work. The markets work on order execution internally. At the basis of it, it works on supply and demand. News and price. Now, this is something I've realized Indians at the Indian market love news and price. They live and die by the news more than any other place I've ever experienced. The US, Europe, Dubai, the Indians love going on to CNBC and thinking, oh, that's where you should be getting your information from. I'm sorry to break it to you, but that's not quite right. It's not the way a professional would think. I've never looked at the news in my entire life. Okay, because the way internally the markets work is on expectation and not reality. Look at the NASDAQ, for instance, in the US, if anybody's familiar with that. Or look at our markets. They've just turned around completely, seeming from nowhere, because it's the expectations of people expecting the market to go up. And all the worst that could happen has already been factored into price. This has already happened, if not months in advance. It's happened within a few hours or minutes of any sort of news coming out. Unless it's something completely unexpected like the COVID-19, markets already have everything really factored into the price. Let's say a professional, an institution, they have data way before it is widely available or before it is widely obvious. So let's focus on the second point. Since we can't get data that is widely, before it is widely available, unless people have internal knowledge, it is before it is widely obvious. I was very impressed with the way Dr. Shah spoke about how he's looking and projecting different sectors. He's projecting it out before the data is widely obvious through common sense, right? So anybody can do that. You need to think before the market does and find the opportunity before everybody else has. If the news is on CNBC, you're already way too late. It's like buying a bag of Lay's tomorrow for 20 rupees when it was 15 rupees today. Because CNBC told you. We don't do that in real life. It's 50% more expensive. Why would you do that in the stock market when you wouldn't do it the way you do it in your own personal lives elsewhere? You have to do your own research and find something the rest of the market doesn't see. Don't chase exceptions, chase consistency. Everybody hears about perhaps the part of the big runner that made them a lot of money, but what they lose perspective of is all the losers that wiped out the money that they had made through that one big winner. Unless you're significantly more accurate, that's the case for most people. So it's basically, again, probabilities at work. Let's say your trading system or your investing system, whatever it is, 8 out of 10 times tells you, okay, I should not be getting into this company. 8 out of 10 times it doesn't. But the 2 out of 10 times that it works, and you saw all these bad signs in the company, suddenly the price skyrockets, you'll always think about it, oh no, why did it work out of that 2 out of 10 times? Because it's human nature to think about the one that escaped versus the 8 out of 10 times that you lost money doing the thing you shouldn't have been doing. Okay? Over a lifetime, you should be chasing consistency. Your bank account won't lie then. Don't chase the story that you want to tell your friends with a glass of whiskey at a family party, okay, or any party over there. You got to chase consistency over a lifetime. And the next thing over is this is a little section that I wanted to talk about, is a little reevaluation of risk. Okay, how people tend to split up their portfolios. It's just a suggestion. This is not the only way you have to do it. But the way I think about risk adjusted returns is not per se, oh, if I put in 3 lakhs into one company and 3 lakhs into another, how much am I going on to earn on the underlying capital that I invested in the company? No, I'll think about my entire portfolio. So how much percentage of my entire portfolio risk am I going to be making on each move? This makes sense when you have a stop loss in the market, okay? Because then you can answer the golden question of how many shares do I buy, for instance. Okay, so let's just go through this. This is an extremely simple calculation. What I usually do is, let's say if I'm risking 1% of my underlying capital, 2%, 5% of my capital. My capital means if I have a 10 lakh account, for instance, how much am I going to make as percentage of that capital? Okay, so if I am going to make, if I'm going to risk 2%, I'm going to look at least getting 4%, doubling the amount that I'm going to risk. Because what that means is out of every 2 trades that go wrong, 1 winner will wipe that out. But now if you can make 5, 10 times what you're willing to risk, it'll take you 10 bad trades or investments to wipe out that 1 winner. Over the long period of time, if you're fairly accurate, that's how you will consistently make money. So this is just an extremely basic calculation of 2 hypothetical things. So let's say your portfolio size is 10 lakhs. You want to risk 2% of that portfolio, which is 20,000 rupees. How do I know how many shares to buy for that 20,000 rupees? So let's say your position size of what it's called is your max risk amount is the distance from your, it's your max risk amount divided by the distance from your entry to your stop loss. Okay. The reason this will work is, let's say Tata Motors, you're risking 10 points versus risking 10 points on Nestle. They're completely different valued stocks. In Tata Motors, suppose you make 3 times of that 10 points, make 30 points, you could make making a lot more money than making 30 points on Nestle. So let's just look at an example of Tata Motors. If your entry is at 87, your stop loss is at 80, what is going to happen is how much are you willing to risk? So 20,000 rupees divided by 7, and that is how many shares you should be buying. And that is how much capital you should be putting into that stock. Okay, Nestle India. Now, if I want to risk the identical amount of money, look at the balance of how many shares I'm only going to get. That's 20 shares. But I have to put in more capital into that, obviously, since it's being a higher valued stock, right? But at the end of the day, if you lose money on this, or if you make money on this, you will be earning the same amount of money, no matter the company, no matter what the price point. And this is a way where you can perhaps stay consistent. Of course, there are strategies out there which everybody does. If you want to buy into companies that give you good dividends, etc., so on and so forth. But this is just for people. I know some people would love to be day traders over here and do a trade in the morning, go off, do their morning surgeries, come back and see if they've made money. This might be a good idea for somebody who thinks about being a little more active in the market, because at the end of the day, you can't fear the fact that I'm going to lose a lot more than I ever anticipated to. Okay. So now the next thing over. So now, what about the Nifty? Everybody's going to know when the market is going to turn, what it's going to do. Okay, so one of the Bombay Ophthalmic Association's doctors, Dr. Feroz Patel, and my dad were actually the 2 people who got me into trading. And Feroz and I were discussing in the middle of March that Nifty was now coming in a place to buy. So both of us were thinking, okay, if the market is not seeing this, this might be a good opportunity. Yes, I got nicked out in a few trades. There are a couple of things here and there, a little couple of stop losses, but I bought fairly aggressively with certain parameters. It starting from the 25th of March, I think 3 or 4 days after the market had shown its signs of turning. Okay, so this is, the way, like you say, I've said a professional might think, I know my entries and exits into a market way before they even happen. So just a projection of what I think might happen with the Nifty, it could be wrong. And my targets are very different because I have leveraged targets. Okay, so even the smallest move can earn disproportional amounts, let's say through futures or options. But in the intermediate term, this is the way I see things. The long on the Nifty, I was looking at a shade below 8,000. So I would be pretty keen to get back in over there to have things move up in that direction. And the Nifty is definitely going to face some sort of resistance and difficulty in price moving up at about 10,300. But what we must understand is the way an index works. It is designed to go up over time. This is what people don't quite realize. What is an index basically? An index is basically, it's an accumulation of the top, in our in our case, it's a accumulation of the top 50 stocks in the country. The worst ones will get replaced. You have things like SIPs, which are just monies indiscriminately thrown into the index. CEOs of those companies are incentivized to keep their company's earnings good. So underlying the fact is an index is designed to go up over time. And shorting the index over a long period of time is at times, unless you know what you're doing, an inconsistent strategy. I love shorting the index. Don't get me wrong. It's one of my favorite things to do because fear will always outweigh greed, but we need to understand the way an index works. Okay, so now what happens in the long term if things really change? In the long term, I'm looking down at the level at about 6,820, which is what I say it's average odds. It means that price could turn from there. It's not the best level, but if things really go wrong, I'm willing to get in at 6,300 again. Okay, and I don't mind that. My positions over here all will have stop losses, and I'll be booking out. I don't mind. I'll be indifferent. It doesn't matter to me if the index falls. It's a dispassionate view, but at the end of the day, you need to be ahead of the market, right? And for the short side, you will definitely at the all-time high be facing some sort of resistance and a sell-off again, because all these traders will be coming in. Oh, is the market going to go up or is it going to go down? You don't know. At the end of the day, you don't know. And the fact that you have to accept that you don't know what your results or where things could go and just let odds play out again and again is the way you need to think about it. And I just wrote this up right now because everybody wanted to put in a disclaimer. I'm not certified yet. So just please consult a professional before just jumping into the markets. And if I do jump into the markets, it's always with a stop loss and knowing where I'm going to get in and out, whether it's for a profit or a loss. Thank you.
Thank you, Ryan. That was a very, very nice presentation. Very
Thank you.
basic as well as complicated points made very clear. Ramesh sir, any comments on the previous topic?
I think it was wonderful. The only thing is, I don't understand this stop loss and other thing. I always buy the shares and forget it. Because 2-3 times in the past, except once, where his father has helped me to make money in Reliance Capital, if I'm right. Barjor is there?
Yeah, but
I can see him. Yeah.
I'm unable to unmute him. So please unmute yourself. Yes, we can hear you. So first of all, congratulations to you also on behalf of your son for an excellent presentation.
Thank you. Thank you. He's teaching me now.
He's not the easiest student, huh? Anyway.
RC sir wanted to ask something or discuss something with. So can you unmute yourself, RC sir?
Yeah. See,
we can hear you. We can hear you.
So I don't understand this stop loss and other thing. I tried once or twice, except once where Banaji helped me to make big money in Reliance Capital. I think we purchased at 1,500 rupees, where he phoned me and said that RC, please buy, because this is the best of the chart he has seen. I don't know whether he bought or not, but I definitely bought about 50,000 shares. No, I bought it 50,000 shares at that time at 1,500 rupees. And probably in a very short time, I made a money of 50 lakh rupees from Dr. Banaji. But subsequently, when I tried to do it myself, I lost all my 50,000 rupees. So it is not my cup of tea. So I don't understand. I always buy the shares and forget it. I don't get involved into it.
And that's just a discussion of your edge in the market, right? You see something in the way you execute is different from mine. And that's the beauty of the market. You can do anything you want.
Yes. What Ryan has said is perfectly right. And those who can do it, I think it's a wonderful thing. So I think it is a great thing, but you have to understand the subject better than what I can even think of earning, because my capacity to understand that much is limited at this age.
I wish I had your understanding, RC.
So can we move on to the next presentation?
Absolutely. Please go ahead.
Yeah. Try and stay around. We might have some questions for you.
I'm around. Don't worry.
Manoj, sir, are you ready?
Yeah, I'm ready. Can you unmute me? Can you hear me?
Yeah,
Yes.
much
Better now? Yeah, I've changed the laptop. I've changed the headphones also. So hopefully it's better now. I'm holding the mic next to my lips, as you can see.
It's very clear now.
Yes,
Yeah,
sure.
okay. And are my slides also visible now?
Yes. Yeah. Well seen, sir.
Am I okay now?
Yes, please go ahead, sir.
The texture also okay for now. So you've had two solid talks of direct stock investing, and I'm going to talk to you about passive investing in stocks and mutual funds. Okay, so what you heard is from the experts who are into technicals and a big pool of money and big deep pockets with lots of dollars and gold for you to go into it. But if you can't fathom that, if you don't understand those things which I can't, then what I'm going to talk to you is your cup of tea. Okay, so I'll be talking to you about mutual funds. I'll take it as I go along. I'll be talking to you about basics of mutual funds, and what is it, how do you analyze it, how to invest, what to invest, what are the rationale behind investing in which type of mutual funds, and how to go about. Let's start. Okay, so I obviously am an ophthalmologist like you all. I don't have any financial qualification. So, okay, this Virendra Kumar, I've been following him for the last maybe 15, 20 years. I read him a lot. He's very well known in the field of mutual fund. He's always on radio, TV, and he's got magazines and online also. Okay. Now, as I said, this is a talk by an ophthalmologist like you all. And as RC always says, what you make or you break from this talk is ultimately up to you. We are there to guide you and hope that. Okay. Now, as you've heard the stalwart speak to you now, always heard about this Sensex. The Sensex started in about the year 1979, and since then, it has had about 5 or 6 episodes of severe drops. As you can see on the table there, ranging from about 33% to 54%. But in spite of all that, from the beginning till today, in spite of the corona effect, the Sensex has grown for over 300 times in the last 35, 40 years. Okay, which nobody can give you. Even if you look at the property market, you hear people saying that, oh, I bought a property and it's gone over 50 to 100 times in the last 30, 40, 50 years. That is just about 7% growth. The share market, the stock exchange, and on mutual funds has given you about 12 to 13% growth. That's about 300 times. The daily market is only about 50 times more. That is if you are lucky. And today it's in the doldrums. Okay. And it's not, the mutual funds are not as complex as the chakra view. Okay. Now, what is the meaning of mutual? It's an English word, mutual meaning share. So in finance, it is used to describe trust or funds that people pool in money and they buy. Okay. It's a mutual is a word meaning two people or groups sharing. How does it work? Now, a mutual fund company called as the AMC, it's known as the Asset Mutual Company, Asset Management Company. They pool in money from different people, and let's say 5 of us, 10 of us, 100 of us, lakhs of us, pool in our money together and give it to a professional fund manager. Now, which manager do we give? Every mutual fund is specific for a specific role to play. Okay. Now, there are hundreds of types of mutual funds, all catering to all different segments of the market. So you decide which you want to put into. Suppose you decide to put in an X mutual fund, and then in that X mutual fund, there will be different companies managing it. So you can choose an A company of X type and give him your money. They're professionals, they research the market and do everything, and they invest your money, pool money from lakhs of people, and they invest the money in the market, whichever you have told them to do. Okay, and when that fund return generates money, that comes back to you in the form either growth, or you can grow the money as cash. This is how the basics of the mutual fund industry works. Okay. Now, what is a mutual fund unit, or what is an NAV? Am I really audible to you all? I have not getting any feedback.
Yes, you are audible,
okay,
sir.
Yeah, okay, thank you, Swapnish. Yeah, now what is a mutual fund unit, or what is NAV? Now, this is the most common thing you will hear in the market from everywhere. NAV kitna hai, NAV kitna hai. Now, what is NAV? I'll give you a standard example of this. Let's say you have a box of chocolates costing 40 rupees. Now, there are 12 chocolates in it, and you can only buy it as a box. Now, you have only 10 rupees. So it's a box of chocolates for 40 rupees containing 12 chocolates for 10 rupees. So what do? You collect 3 more friends of yours, and each of you contribute 10 rupees. So what have you got? You collectively bought a box of 40 rupees, and each one of you got 3 chocolates. So what is your share? You've got 10 rupee share collectively, but what's the cost of 1 unit? You bought 3 chocolates for 10 rupees, so 3.33. So your NAV, net asset value, at time of purchase is 3.33. Okay, so that's your net asset value. Now let's say after 1 year, the cost of the box of chocolate goes from 40 rupees to 80 rupees, and all of you decide to sell it. So that means you sell it for your unit will be, your share will be for 20 rupees. So your NAV at sale becomes 20 rupees by 3. So it becomes 6.66. Okay. So what does it mean? Your NAV at time of purchase was 3.33. The NAV at time of sale was 6.66. How many units did you have? You had 3 units at time of purchase, and obviously you can only sell 3 units at time of sale. So you made a profit of double, okay, 100% over a period of 1 year. So this is how NAV works. Okay. Now, there's a very common myth in the market that low NAV is better. It is not so. NAV is just a number. Okay, don't confuse it with anything else. NAV is relative. It doesn't mean that you buy a low NAV mutual fund, it is cheap, and you buy a high NAV mutual fund, it is expensive. It is just a number. It doesn't make any difference. It just depends on the growth and the pattern of the mutual fund. Okay, the confusion over NAV arises because we think NAV like a stock price. So we think if the stock price is low, it is cheaper. It's nothing like that. It doesn't behave like that. Okay. Next thing is that we always feel that mutual funds are an assets class. No, mutual funds are a vehicle where you can use mutual fund to invest in different types of assets. You can use mutual funds to invest in equity, to invest in debt, to invest in bonds, gold, real estate, commodities, fixed income, etc., etc. So mutual fund can be used for each and every of these things. The main advantage is that you can have a mixture of all these easily without any problem, all with professionals doing the work for you, sitting, and you can sitting and you can quietly relax in your office. Okay. So mutual funds therefore should be treated like a portfolio of financial instruments and not as a financial product. What are the advantages of mutual funds? There is no entry load. There is a very small exit load depending on the duration you hold it. And if you do it on your own, then there is no brokerage. There are significant tax advantages. It is very safe, totally transparent. You can invest in the name of HUF also, and you can diversify across different asset classes. It is not complex, it's simple, and professional management. You can do what you want with it, SEBI regulated. You can invest even 500 rupees at a time, highly liquid, repeat redeem anytime. Okay? And you can nominate anyone you want. And you can invest in international companies also without any problem at negligible risk. Okay, it removes confusion, and you can invest even 500 rupees at a time. What are some facts of the Indian mutual fund industry? Total mutual fund industry in India is about 26 lakh crores, which is negligible. If you just consider the biggest mutual fund company in the world is BlackRock Group of USA, which is managing 460 lakh crores. Okay, and we are totally only 26 lakh crores. And we've got about 43 AMCs in the country today. And 90% of the equity funds invested in the top 500 market cap stocks in India. Now, what to look for in a fund before investing? You should look at the pedigree of the fund house, the track record of the fund house, the past performance of the scheme, the market scenario, etc. Some of the websites which you can get a lot of information on is veryresearchonline.com. That is my most favorite. I spend the time, significant time of it on it every day in the morning. Okay, that's my most favorite one, and there are other various ones there. You can also physically read sites of the financial papers and individual asset management company sites. The registrars, main ones are CAMS and Karvi. And to transact online, today you can do everything online. You do not visit a mutual fund company or physically do anything. The most popular or the most commonly one which I use is mfindia.com. There are other ones also. Okay. Some of the papers which I read regularly, two of them I would list here is one is ET Wealth newspaper, which is issued by the Economic Times as a separate supplement, comes on every Monday, costs only ₹8. I feel all of you, it's on mutual funds and personal finance. And second is a Mutual Fund Inside magazine, which I subscribed for the last, I think, 8-9 years. Its average cost is about 110 rupees a month. So these two things I've got with me also here. So these are things which I read regularly. Okay, what are the different types of mutual funds? This is interesting. So first is, what are the different types of investment of fund? You can invest in equity, debt. Hybrid means a mixture of these two. commodities, index funds, and funds of funds. Now, I've got different mode of holdings, direct and regular. I'll talk a little bit of each of these later on. Mode of holding could be single, joint, etc. Duration of fund could be open and closed-ended. Expenses, type written. Growth is always better, and you can invest periodically in the form of either SIP, STP, and SWP. I'll be talking a little bit of some of these terminologies as we go along. Okay, now the most important is what's the types of investments you do. One is equity, debt, hybrid, and commodities. Now, what is equity? As my previous two speakers said, they're experts in the equity market, but they were talking about direct investing in shares, and I have practically zero knowledge in those. So the equity mutual funds will invest your money in equity market. So they will, depending on where you invest, they will put your money into different types of equities. Professional managers, just as RC and Ryan said their research they do. So these professionals research in their own way, and they will invest on your behalf. Okay, since they're equity, if you're investing for a long time, for at least 5, 7, 10 years, 20, 30 years, then equity is going to give you far superior returns. The advantages, professional management, minimum cost, and no headache and no worries. Second is debt. Debt is they invest in the bonds, deposits, money market, government bonds, gilts, etc., etc. They are relatively lower risk, but then lower returns, and they're suitable for up to 3 to 5 years of investments. Third is hybrid. Hybrid means mixed. So they would invest in equity and debt, both of them in different proportions. The last is commodities. They invest in the gold, bullion. Okay. Now in equity, we've got various types of equity funds. As I've listed there are about 8 or 9 of them. Large cap, large and mid cap. This depends on the market capitalization of the shares in the stock exchanges. Okay. Then we have the debt types. There are about 17 types of them. Okay. The better ones are the short duration, liquid, and the gilt funds. And in hybrid, we've got about 7 or 8 of them, depending on the ratio between the equity and the debt. And some of them would have a little different allocation in the form of arbitrage, dynamic allocation, and multi-asset allocation. Okay. Let's talk about how do you invest. Now, one is you can do it yourself. That is the direct investment. And second is the regular investment. Okay. Now, what are the difference to? Now, if you do direct, then regular plan is where you've got an agent or a broker investing through you. Okay. So approximately 1% is given as brokerage to that agent. Direct is when you do it yourself. Now, this is the biggest difference. Till 2013, we did not have this category. 2013, SEBI set up a separate category called as a direct investment. Now, if you want to save 1% in a year, which is a big amount, believe me, if you think 1% is not much, but 1%, if you've invested for about 7, 8, 10, 15 years, that makes a difference of almost 17 to 18%, which is a huge amount for the agent who's doing nothing for you. And if you've invested a huge amount of money, it is very high amount. Okay. So, and he gets it every year, irrespective whether you make money or no, the agent is given 1% every year. So, and this is given from the cut from your NAV. So you may think that you're getting the full money from the mutual fund company. It is not like that. It is cut and then given to you. So direct is always better. Okay. Now there's a difference if you invested, say 5,000 rupees a month, say for about 10, 15, 20 years, the difference comes to over 1.5 to 2 lakh rupees. Okay. Next is the types of systematic terms. We've got 3 types. One is SIP, STP, and SWP. Now you hear people saying, I've got SIPs running, I have SIPs running. I've asked sometimes people, what do you mean by, what is SIP? They don't know. Okay, so they've heard somebody saying and they've done it, they don't know what it is. I'll just tell you briefly what they are. SIP stands for Systematic Investment Plan. It is the best way of investing money in the mutual fund category. A fixed amount of money which you decide, on which date you decide, which mutual fund you decide, and which aims you decide. On that day, that amount will automatically be get cut from your bank account, and it will be invested directly. You decide when to start, when to stop. You can change it, modify it, stop it, start it whenever you feel like. And now it can be done online with a click of a button. This is the ideal way to invest in a equity mutual fund. Okay, so that you don't fall into a big volatility. Second is STP, which stands for Systematic Transfer Plan. This is you are shifting money from one scheme to the other one. This can be done only in the same AMC. Usually it is done from a debt fund to an equity fund. This is what I know. This is similar to an SIP, Only thing is in SIP, the money goes from your bank account. In STP, it goes from your debt account. This I normally invest in. I put whenever I have some money, I put in my debt scheme, and automatically it goes by STP to the equity fund. And third is SWP, which stands for Systematic Withdrawal Plan. In this, the money is removed, which is what you do when you want to withdraw money. The money is a reverse of SIP. The money comes directly into your bank account, again depending on how much you want, when you want, for how long you want, etc. It's all online, easy to do. Okay. Now, what is the advantage of SIP is that it averages your cost, because equities are volatile. So when the market crashes, with the same amount of money you buy more units of the mutual fund, and when the market goes high, you get less units. So it is called as rupee cost averaging. Okay, it brings in discipline. You get power of compounding. Convenient, no need to time the market, not to worry what is market is crashed or not, and it is flexible. It makes simple. Okay, SIPs are on a few things. You should decide how much money you want to invest, what is your risk profile, how much money you are willing to, how much comfortable you are with the volatility, and how important that money is to you, and what is your goal. Okay, so all these things need to be considered first before you decide, and then you need to then choose on the type of fund. All my investments are in joint is me and my wife, and it is all of them are on either or survivor basis, which is very useful in terms of managing the fund and in succession planning. So please, if you have got investments, try to shift them to joint holding, but the holding pattern should be either or survivor. It will make your life easier in the long run. Believe me, if you've not done it, it is not difficult. You can do it now also. You can shift. All my investments are in direct, so I save at least 1%, which is a huge amount of money. And you can invest either one-time lump sum or SIP STP. You have to be KYC compliant. Now, what is KYC? It's called as know your customer compliant. If you are holding any mutual fund, even existing now, even any mutual fund, then you are automatically KYC compliant. Then you do not do anything. If you don't hold any mutual fund whatsoever, then you would need to become KYC compliant. It is easy. You can do it online also. They have started, because of the corona, they have started online video KYC compliance can be done. Okay, obviously PAN and bank account are necessary. And you can invest online through various AMC sites, through mutual fund utilities, or through different bank portals or demat accounts. But if you're doing through demat accounts, then remember it becomes a regular plan. Your demat account the intermediary will be getting 1% commission, though may not will refuse to that they're not getting it, but please believe me, they will get commission. This is what a mutual fund statement looks like. Okay, it has all your personal details, your bank, your account number, folio number, your holdings, amount invested, current value, the NAV, the date of purchase, transactions, bank account, KYC, agent, broker. Okay, now remember one thing, I had somebody calling me up 4 days back. He was not sure whether his investment are in a direct or a broker. So I said there is a column called as broker, and it will have a ARN number or a name written. Okay, so check that. If it is there, it means that you've got a broker. You may not have done through a broker, but broker is there. Or you see, look at the name of your investment, of the scheme. If it is direct, then the word direct will be written. If it is not written, then it is a regular plan called as a agent plan. Okay. Now, what are the mistakes you should avoid? Don't let your heart rule your head, as these people have been telling you. Okay. Don't become emotional in the market. Don't stop SIPs. Don't panic. Don't hold too many investments. If you do, then it becomes difficult to manage and keep track of them. Don't time the market. It is important. It is a time in the market which is more important than timing the market. Okay. Don't procrastinate. Invest now. Okay. It is not how much you earn. It is how much you save. It's not how much you save. It is how much you invest. It's not how much you invest. It's how well you invest. It's not how well you invest. It's how long you invest. And it's not just any of this. It's all of these. Okay. What are the some some of the myths of mutual funds. Okay, people believe that it's only for people who've got a lot of money in the market. A lot of money, no. I have had, this is a big myth which is there. I have some of my hospital nurses and my clinic staff who've been investing 500,000 rupees a month for a few years. Never invest in an FO. Anybody can do it. As I said, you can do it in your name, and they don't have all don't have a lock-in period. You can sell market whenever you feel like it's easy online. Okay, you can take loans against them. They're tax efficient. You get professional management. Okay, and even for debt funds, they are better than bank fixed deposits. Okay, are you all confused? So let's see in simple now. So first, you decide what is your duration of investment. If you're investing for up to 3 years or so, then it's better to go for a debt mutual fund. So there are many of them you can choose. If you're investing for medium to say 3 to 5, 6, 7 years, then you can go for balanced funds, which are hybrid funds. You can choose among this. If you're investing for long term, maybe 7, 8 years, longer, 10, 15, 20 years, when equity is idle, then you will make the best of the market. Okay. Now, in a nutshell, how many funds you should invest in? Okay. You should probably choose multi-cap funds. Multi-cap funds are ones which can invest across the equity market. You are letting the fund manager as a professional decide on your behalf where he wants to invest. Like RC said, he prefers mid-cap and small cap. So you leave it to the manager. He's a professional. He will decide what is best for you and he will invest. So you can choose those. You can also, maybe up to 3. You can choose aggressive hybrid funds. Okay, aggressive means where it is equity oriented, where the equity component is about 65% and more. So you get benefit of both for medium term saving. And ELSs are the section 80C benefit, which you can invest up to 1.5 lakh rupees a year. You can choose those. Okay, and maybe you can choose 1 mid cap and 1 small cap fund. And if you want to play safe and go only for safety, then you can put in short term deposits, short term debt funds, which give you much better returns than a bank fixed deposit. In fact, the bank fixed deposit is currently at about 5.5%. Okay, so that's it. You need not invest more than 7 funds. Okay. Now, okay, I am sure all of you heard of Warren Buffett. Yeah, so there's a lot of quotes. Now, these are some of the funds I've listed some of them, but you all can actually go to any mutual fund site, or there are many sites available. As I've listed some of them, and they will all give you a list of top funds in large cap, large and mid cap, etc., etc. I've listed some of them, but it's not practical to name. In India, we've got about 2,000 mutual fund schemes. And if you take the variations, it goes to mind-boggling about 7,000 to 10,000 schemes. Okay. Now, so I've listed some of them. Doesn't make sense to actually naming them, but this is I've taken from the ETL newspaper at Tulips. I've just cut and pasted them from them. But as you can see, there are many of them around. Okay. What you should do is identify, depending on your risk profile and your duration, choose good funds and invest them for a long time. This is a very common, a very popular graph showing different types of schemes which you can choose. Maybe when we have question and answers, I'll be able to elaborate a little more on them. Okay. Now, there are certain called as international. And this is, I think, I want to just stress a little bit on it. Okay. It's always said that you should always diversify. So you don't have all eggs in one basket. You invested across various different types of assets. Similarly, international, it's always said that you should have about 10% of your investments, if possible, should be in international market also, so that you get the benefit of the exchange risk as well as the growth in different markets. Like India may be doing well now, sometimes some other market will do well. So, but the problem is that how do you invest internationally? Either you open a foreign demat account and then research those markets, which is practically impossible, and buy shares from them, but they'll be very expensive. Or you can invest in India and buy Indian mutual funds which invest abroad. Okay, the only thing is we've got about 20 to 30 international mutual funds in India. But the problem is that from taxation purposes, these funds are treated as debt mutual funds. So up to 3 years, the gains are related to your income, and more than 3 years, you get long-term capital gains benefit. Instead of that, I just want to mention 2 or 3 schemes. One is I mentioned below, if you see in the bold, is PPFA's long-term equity fund and Exit Growth Opportunities Fund and Kotak Pioneer Fund. They are Indian equity funds, but they invest up to 30% overseas. Okay, so they have more than 65% in domestic equity. Now, the Indian taxation law says that if any scheme is investing more than 65% in Indian equity market, then it is taken as equity scheme, and the taxation pattern is like an equity fund, which means short term less than 1 year is 15%, and more than 1 year is 10% on growth. Now on growth is when you redeem the market, when you redeem. So PPFAS is one of my favorites, and in fact I've got a lot of investments of mine is this scheme. This you can consider as it's a multi-cap fund, and it has got investments in Alphabet, Microsoft, Nestle, etc. Okay, so that's one thing you can consider. So you automatically diversify about 30% of this scheme internationally with taxation of Indian equity scheme. Okay. Now this is how the taxation works in Indian mutual fund market. If you've got equity schemes, as you can see, if it is for less than 1 year, then the gains. Now these are the gains, not the total. So if you invested 1 lakh and you get say 1,15,000 after a year, then 15,000 is your gain. So if you have an equity or equity oriented funds, then if the holding is less than 1 year, then it's 15% on the gain. If it is more than 1 year, it is then 10%. Now this is 10% is more than 1 lakh. So if your gains are more than 1 lakh in a year, only then. And for all other funds, it is 3 years or less. There is no TDS in mutual funds. Now, there's something called as mutual fund utilities. Now, this is an online portal. It is free. It is being set up by the Mutual Fund Association, and all the AMCs are members of that. There are almost 43 mutual fund AMCs in India set. So this is a transaction aggregator portal. I deal through this. So it is free, and on one click of button, you can see all your schemes in the past, whatever you had, and you can transact. You can buy, sell, redeem, SIP, STP, etc. all online automatically, and you can open the account online. You submit your documents today, within 4 days your account is opened, and it is PAN mapped. So for example, if I've got holding in my mutual fund currently, say me first and my wife second, so joint holding, so for example, so then I have to open an account with me first and she second as one account. Then if suppose she's first and second in some other scheme, then I have to open an account in that pattern. So it's mapped as per the PAN holding, and that's how it works. It's very online, and I think all of you should become members. It becomes very easy to see all your portfolio on one side. Okay, one more statement about nominee versus heir. People feel that since we have nominated somebody, there's no problem. After us, the money will go to the nominee. No, please remove this false notion. Nominee in mutual funds is only a caretaker. The nominee will not get your funds after you. Okay, the money will go to either the second holder if you have one, or it will go as per your will or the Hindu Succession Act. So therefore, my suggestion is that please open all your mutual fund accounts in joint names on either or survivor basis. Okay, so that it becomes easier. The nominee is only a caretaker. Remember this, please. Okay. Now, what to do in these Corona times? Okay, if you follow the science of investing, like as RC said and Ryan said, then you need not worry about if you invested the way they should invest it with proper diligence. Then you need not worry about. I'll just give one example of HDFC Bank. Okay, now HDFC Bank crashed. The last crash was in 2008 because of the US market. Hello.
Yeah, continue.
Yeah. Okay. Because of the crash. Now, HDFC Bank is the third largest market cap company in India. And in 2008, if you had bought it before the crash, then today it would have grown about 10 times. But if you had bought it during the crash, if you had bought it before the crash, it would have still grown 5 times more. So it's about 5 times more from its peak in 2008 in 12 years, which is phenomenal. And from its bottom, it's about 10 times. So don't worry about the timing. It's just an example. So if you are scared, the market has crashed 38%, 40%, 35% now. Don't worry. You just continue the science of investing. Invest diligently, peacefully, without worries in SIP form. And in the long run, you will get a huge amount of money. Okay. These are some of the points I have written. Cut down on unwanted and extravagant expenses. Your investments will give you good returns. Don't worry. And be cool, calm, composed, and simply stay away. Stay with family and focus on doing best at your job. Safety and security is in your own hands, and economy is in bad shape. But so what? But it's all over the world. when the economy becomes brighter in the near future, India will be one of the first ones to pick up, as RC said. So our future is bright and it is looking good. Okay. You should have emergency funds for about 6 months duration, so that you could take and tackle these kind of situations. Okay, that's it. Happy saving in investing mutual funds and safe and secure financial retired life. Don't worry too much about making money. It won't change the way you live. Time spent earning money, enough money is time reasonably well spent. Time earning an excess of money far beyond that required to one's mean, however, is time wasted. So you should know how much you need and how much is enough. That's very important. This is probably one of your life mantras. If you feel you've got enough, then cut down on your stress. Okay. Thank you. Okay, now some about extra slides on some of the myths about mutual funds and how they're better. So should I continue? There's about 10 minutes more, or should I stop? Or if there are questions, I can take. Like, I've got slides on how mutual funds are better than gold, better than property, better than fixed deposits, etc.
Will it be over in next 5 minutes? Because we want to take up the questions.
Yeah, 5 minutes then. Okay, 5 minutes. I'll just go very quick. Just 10 slides. I'll go fast then. Okay. Now this is some set of slides on telling you about 4 things. People believe that gold is a great form of investment. Fixed income is better. Real estate is fantastic. And I can invest in data stocks, which probably RC and Ryan may probably hit me after my talk. Okay. Now, myth of gold. Now, this is a slide which I've taken from a newspaper in 2016. Okay. So a bit of 30 years. Now, if you see gold, if you've invested 1 lakh in 1986, okay, just 1 lakh you invest in, you forget about it, then gold would have given you, after 30 years, 1 lakh would have become 1.54 crores. Okay, so if you had invested only in the Sensex, it would have given you almost 5 crores. But equity mutual fund would have given you almost 8.5 crores. Okay, now these are over 30 years, from 1986 to 2016. Okay, now second thing is that people are telling me that in the last 1 year, the gold has given almost 40% return. But this is an exception. This is just one incident. Just don't take one black swan event which has happened. Consider the long-term history of in the past. This doesn't happen. This will not happen in the future again. So just because it has happened because of Corona and the gold in the last 1 year, I think we should not get swayed by it. Okay. Now, fixed income. People say that the mutual fund, maybe some of the fiasco which has happened recently, the Franklin Templeton and the DHFL and other things in the recent past. Nothing like that. These things happen. So similarly, so many banks have folded. Okay. Now, the advantage of investing in debt mutual funds over bank fixed deposit is primarily the taxation benefit. When you put in a bank fixed deposit, the interest is treated as interest income, which is added to your income every year, irrespective of whether you withdraw the money or no. While in mutual fund, the increase in the in your scheme is treated as capital gain. So if you invest for 3 years or more in a debt fund, then you get long-term capital gains benefit, and the difference in return is here. So effective return on a fixed deposit, let's say, is about 5.5%. So correspondingly, your debt fund will give you almost 30% more. So if investing even in a mutual fund, even if a debt scheme which is conservative, you will earn significant more amount than a bank fixed deposit. Okay. Now, and if you compare fixed and mutual funds, then you can see this. This is over a period of almost 20 years till 2015. Okay, the PPF account gave almost, say, 51 lakhs. Sorry, 51 lakhs. Correspondingly, you would have got about 4 crores in a mutual fund. Similarly here. Okay. Now, even if you consider the effect, then PPF is handsomely beaten by a mutual fund. So if you see from April 2000 to April 2020, this is still last month's statistics. So over about 20 years, PPF would have given you 30.5 lakhs. If you've invested, say, 1 lakh, if you've invested 12 lakhs, okay, 5,000 rupees per month. Okay, you would have invested 12 lakhs, PPF would have grown to 30.5 lakhs. In spite of the crash in the market recently, you would have still got 55 lakhs in a mutual fund. Okay, and myth of real estate I've already mentioned. Mutual funds have given you 300% if you consider the crash now. Otherwise, it was 400%, 400 times the value of mutual funds as compared to real estate, which would be about 50 to 100 times. Data stocks, I think nothing much there. And yeah, this is just a very, very nice statistic story I like to tell. This is a fact. This is a fact when the figures are hypothetical, but the incident is a fact. These are the last two slides. In 1626, Peter Munich, if you don't know, Holland, the Netherlands were the investors, or they had bought the land in Manhattan. Okay, they were the first settlers there. So in 1626, Peter Munich, he was the Director General of the Dutch West Indian Company, had purchased Manhattan. Okay, from the Delaware residents in that time. Okay, and what did he pay? He paid them $24 worth of trinkets. You know, the necklaces, etc. The value of this land. Okay, so if the Indians had not sold that property to him, then the land value of Manhattan today is $29 trillion. Okay, is it a great investment? No. Okay, now why is it no? Okay, now let's say hypothetically, he had invested that $24 in a hypothetical New York Stock Exchange at that time. The value of that would have been $300 trillion today, which is 3 times the value of the world's total stock exchanges. Okay, need I say more? Thank you. Swapnesh?
Yeah, thank you, sir.
Okay.
Thank you so much for the presentation.
I hope I was audible.
Yeah, absolutely, very clear. Thankfully, we changed the laptop.
Yeah, I changed the laptop. I changed the. Luckily, my son was here, so I could do that.
So quickly, we'll take the questions.
Yeah.
Because the audience has been engaged for more than 1.5 hours.
Yes, it's a very patient audience. Thanks to them. I hope they have understood also everything, because
we had close to 175 people.
That's excellent. That's very nice.
So Dr. Janak Shah has been, and Dr. Preetham Samant sir has also joined in.
Yeah.
So Preetham sir, can we take the questions quickly?
Yes.
You have the chat box open, or should I ask?
You ask.
Okay. Dr. Janak Shah has been asking, what does an investor do if the mutual fund goes south? Example, Franklin Templeton and all mutual funds for first 2 years returns are negative. So do we need to hold them for a longer time?
See, as I said, you need to first be aware before you jump into the sea. Just try to figure out whether you're swimming or not and the depth of the sea. Similarly, when you come to a mutual fund, I hope now that you will first decide you want to invest in which type, equity, hybrid, debt, etc. And you would know the pros and cons of each. Now, coming to the Franklin Templeton, what has happened is for the debt schemes, because some of the schemes, because of the crash in the market and the corona effect, they had invested, because the problem is that there are 43 AMCs and there is a big competition among themselves, because people would invest money seeing the performance of their schemes. So whichever schemes better returns, people choose those schemes. So it is a tough cat and mouse game between the schemes. So some of those AMCs, to chase higher returns, invest in little low quality debt papers. Now what happened was, because of that, the Franklin schemes were giving a little higher returns. Now those companies defaulted temporarily because they could not pay the monthly interest to the schemes of the AMC, to the Franklin Templeton. And because of which, because they did not get the dividend or interest from these companies, to safeguard the interest of the mutual fund investors, Franklin Templeton announced it and they put a hold on this. They also approached the RBI. So RBI said that you make a side pocket of those things, those amounts, and list them. So then nothing, it's just pure bad luck. So what the investors can do, just wait. There's a chance that they will get the money after some time. Okay. Now that's what we come back to, is between risk and returns. There's a general saying in the market that higher the risk, higher the return, lower the risk, lower the return. But conversely, it does not mean that if you take a higher risk, you'll get higher returns. It's not always like that. Or don't assume. Okay. So you should, such a thing can happen once in a while. I think you have to wait and watch, and you will get a decent amount of money back. So don't worry.
The next question is from Dr. Hemant Sakpar.
Yeah.
How to shift from regular to direct plans of existing mutual funds?
Yeah. Okay. Now this is very important. As I said, what you should do is that 2-3 ways to go it. One, you can do online. So if you already have your access to your scheme existing online, then just go to that site wherever you got, and you will, if you just navigate, you'll get an option of putting. We should also decide whether you want to continue this, because I'm telling this because one of our senior colleagues, I was discussing with him just 5 days back. He called me up and had a long chat with him, and I just guided him about all his investments were in single hold. So I said, you can, since you want to switch anyway, you can add your wife's name to it so that in the long run it's better. And you should, so if you want to see the redemption, so when you switch, it is taken as redemption from one scheme and investment in the other scheme. So it is fresh investment. So look at the taxation benefit also, taxation angle also, and you can do it. So if you want to decide that you want to keep in the same mode of holding and the same scheme, then they can just go online to your thing and just switch, just click, you'll get an option of direct plan, just switch on direct. It'll ask you whether you want all units or partial, switch on all units and it will directly. Now, if you want to switch from this scheme to some other scheme, but in the same AMC, those options are also available online. But if you want to withdraw from one scheme, let's say from SBI mutual fund, and you want to put in, let's say in Axis mutual fund, then you have to withdraw the money. So redeem all the money will come into your bank account within 3 to 5 days. And then you can invest online into the scheme wherever you want. Now let's assume that you don't have, you so far have not done online facility. You can, even if you're not, no problem, you can open an online account. Now that you can be done in 2-3 ways. I told you one side of mutual fund utilities. So open an account online now. Within 4 days, account is opened. All your schemes are seen online. Just click and you can do everything. Another option is you can go to the registrar of that fund. Now we have got 2 registrars in India. One is CARVI and one is CAMS, C-A-M-S. So you can open an account with any of those. All are PAN linked, OTP is given, and you can do it easily. Third option is you can do physically. Download the form, fill the form physically and give it to the company. But in Corona effect, you may not be able to do it. So these are the various ways you can do it. Believe me, even if you're getting losses now, shift to direct plan. In 4 to 5 years, I've not put the slide of that. And I've got, in fact, the magazine here, which I read regularly. There are tables and charts on this. Direct plan, trust me, you will thank me after a few years. You will make a big packet, which you are giving to your agent for doing nothing and he's giving you wrong guidance.
I think one question to Mr. Banaji. How to put the stop loss? How to put the stop loss to prevent hitting the SL? Am I making any sense?
How do we put the stop loss to prevent getting the
Hitting
SL,
the
meaning
SL.
stop loss?
I think that's a question from
Could
Dr.
you
Heyman.
clarify it?
Yeah,
I'll look through the chat. Where's
sure.
the question? How did? No, wait, no.
Till that time, I think there's a question to Dr.RC sir. Dr. Sushil Deshmukh is asking how to invest in silver. No ETF available. Physical is difficult to keep.
Now, silver you have to buy in either coins or the bars which are available and keep it at home or in the locker. There is no non-physical mode of investment in silver. But it is not that difficult. Suppose you buy 20 kgs of silver, you can keep easily. It's a very small amount of space that occupies it.
Sushil, you want to ask something?
Am I audible?
Yes, sir.
Yeah, RC, very well.
See, two more things which I want to tell you if you permit me, because I have missed that thing. So if you permit me, I can talk.
Yeah, sure, sir.
There are 2 scripts which I think I have forgotten. One is MSTC. It's a company which will looking after your scraps. Now, you know, this 1st of April, all the trucks which are more than 15 years has to be scrapped. And also this BS4 and BS6, whatever the European regulations are there, all the cars which are old will be ultimately scrapped. So you can imagine the amount of scrap we are going to create in next 2-3 years. And MSTC is a government-owned company which is available at 110 rupees. And that is one thing probably will do very well in next 3 years because they have so much of work. They were making losses except the last 2 quarters. They have made a significant profit. And the expected earning per share is around 17 rupees. So it's available at a very reasonable price. So it is 107, I think it is 102 rupees. So MSTC, the major holding is lying with the government. It's another script which you have to look after it. The second one is, I think I have bought a Brightcom group. You know, all of us at present are having a Facebook, Twitter, this Zoom and everything. So the TV is becoming little less popular than the social media group. And a lot of advertisement are taking place in the social media. This company is giving they are working on this platform for a long time. It's available at 6 rupees and 39 paisa, 6 rupees 90 paisa. My purchase price was 3 rupees when I purchased, I think 3-4 months back only. Last 3-4 months, it has given me a lot of opportunity to buy the shares. This is another company which I have put a lot of money, which probably might do very well in next 3 to 4 years, because there are a lot of opportunity of good business for these people. The Brightcom Group.
Swapnesh, I can see some questions. Can I answer them directly?
Yeah, sure.
Okay. There's some people asking that all mutual funds are not listed on CAMS. No, there are two companies, two registered transfer agents. One is Carvi and one is CAMS. So between the two of them, CAMS is I think about 16. The rest are the CAMS. So if you want to do with them with the AMC, the RTCs, then you have to go to them separately. But if you go to mutual fund utilities, then they have everything, all of them. So you just need to go with mutual fund utilities. Just go online. You can open an account right now. It takes about 10 minutes for you to upload the documents. You can do that. So then it has got all schemes listed of all AMCs, Carvi, CAMS, everything. So you need not go individually to the registered transfer. Just go to CAMS. There's one question which I can see that when market is performing, mutual funds perform. When market is not performing, then when they're not performing. The thing is that, see, it depends on where you put. Now, if you put, and I believe this question is related to the equity market. Now, if your money is in the equity market, the equity market crashes, then even they will crash. But the difference is that they will crash much less than your Sensex. That's the main advantage of mutual funds. And when the market recovers, they will recover much more. Okay, so that's the difference in professional management. It also depends on it doesn't have to do with debt schemes. If in debt schemes, if the interest rates go down, then the debt mutual funds value increases because the interest and the share, the market price of bond schemes are inversely related. Now in equity, the small caps are much more volatile than the mid caps, than the large caps. So it also depends on that. Because of professional management, you would save, they will fall less than the market and it would grow much more than the market. That's the difference which we have. Okay. Now, somebody asked why they're not performing. The market, as I said, the market is crashed. You can't expect if everything is crashed, you to be, but it'll crash less. And I showed some tables on that. So don't worry.
I found the stop loss question for Dr. Hemant. So it's a little different. You're trying to ask the question of how can I not get stopped out of a trade? So or stopped out of an investment. At a certain point of time, you need to have an idea of how much you're willing to risk. By risk, I mean even a monetary amount. But I have very specific ways I put a stop loss based on some technical ideas. But let's just say, suppose you get into a stock today, let's say Tata Motors, you got in at $70 and you're expecting it to go to, I don't know, 140. Suppose you put your stop loss below $30. So you should, let's say, so 70 to $30 is about a $40 stop loss. Yeah. So you should be at least projecting to earn double of what the points you're willing to risk. So according to that, according to what projection you have, you should be putting a stop loss of half that projection if you're doing to a basic 2:1 growth of what capital you have put into the market. That'll be a basic way to do it. And there's one more question about time frames. So intermediate and long term. Intermediate would be dailies, and long terms would be anything from weekly up. I can even look at 6 months to yearly charts.
Can I answer another question?
Yeah, sure.
Okay.
Sir, how much time we have? Vikram sir?
Pritam, we can continue?
We can continue.
Yeah, okay, fine. Now there's a question. Somebody asked ELSS or PPF, which should one invest in? Now, I gave a slide of that. That was a slide over a period of 20 years from till 2016. Now, if you see that period, even before that, ELSS has given significantly higher returns. So in the last 1 year, or where the ELSS funds have not done well. So, but your investment is PPF. You're looking for long term, 15 years and above. Then it should be in equity. So ELSS will definitely beat PPF as a tax saving instrument in the long run. So I would not say PPF. No, ELSS. Okay. There's somebody who's asked that should we temporarily increase the SIP amount? Yes. In fact, this is the right time. The market has crashed. You're buying on dips. So if you can do it, you will be buying at lows when the market goes up. Whatever happens, even if the market goes down further from here, after 1 or 2 years, I'm sure both of my colleagues will agree. The market will go 45, 50,000 or whatever in the next 2-3 years. So you're going to buy cheaper now. As RC was saying, some of these scripts have crashed now. So similarly, same thing for mutual fund. You're going to buy at a lower rate now. And when the market goes up, your costs, your returns will be much higher. So if you can do it, do it. But again, SIPs over the next 6-8 months or a year.
I think there's a question here for Ryan. Ryan, who earns more, you or your dad? I don't know what your answer will be, but I can definitely tell you one thing, that you don't need a PPE to do your earnings. Your dad will.
Yeah, I know. So, well, I'll let him answer that one. But for now, my income hasn't stopped at all. So,
Am I right? Can you unmute Banaji sir?
Yes, I'm trying. Sir, click on the mic button. Banaji sir. Yeah, you can. Yeah, you're audible.
But Pritam Barjar is a long-term investor. Ryan is a new investor, short-term.
No. Long-term, short-term. As of the last 3 months, my earnings have been -100. His have been a lot more.
I think we have any more questions? Or...
This is a good question for Ryan to answer. Yeah. Who earns more, a trader or investor?
Depends. That's a pretty tough question to answer. You need to be a trader or an investor. It's a very loose term to me. I would categorize both of them as market speculators, because at the end of the day, you need to be in the market to make it. So over a long period of time, to get disproportionate amounts of money, it would be somebody who has a mixture of active trading and long-term views. That's the way even I look at it. So for instance, my trading portfolio is very different from the way I would manage that's an investment portfolio. The investment portfolio will be more conservative, longer-term moves, versus, let's say, a trading portfolio would be hyperactive and disproportionate amounts of risk to return on smaller capital.
Okay.
Yeah. One more thing which I forgot to tell you, if you can allow me.
Please go ahead.
See, there is another script which I think got a great potential to go up. Two of them are interlinked. One is a Vaishali Pharma. You see, the drug delivery system is going to change now. Probably oral tablets will gradually go down. We'll have a sublingual wafer-like delivery system. Vaishali Pharma is in a big way in that particular segment. They already started exporting in many countries, and you see recently vitamin D3 60,000 unit has come in the wafer form of, you can put it under the tongues and it melts in about 30-40 seconds. So ultimately all the oral side effects, stomach side effects, all these things will come down. Probably even Viagra is on the way to have a sublingual form of delivery of system. So Vaishali Pharma is one thing. Second one is the one who is making this film, and that is Aero Green Tech. They are the people who are going to make substitute of plastic which is biodegradable. And it is available at 32 rupees. In the past, I have purchased at 10 rupees and it went to 600 rupees. So this company has a record of multiple times return. They have increased the stake recently. The company has increased the stake. The management has increased the stake, and that is Aero Green Tech. These are the two companies I forgot to tell you. One is Vaishali Pharma, and the whole stock market, when it crashed from 40,000 to 25,000, Vaishali Pharma has not gone down 1 rupee. So these are the two scripts which probably might be giving a good return, at least 100% per year for next 3 years.
There's one question about should the asset allocation in mutual funds or data stocks be related to the age of the investor? Can I answer that?
Yes, sir.
Yeah, okay. Now there's a traditional thought that you should invest in equity 100 minus your age. So if your age is say 40 years, 100 minus 40, 60. So 60% of investment should be in the equity market and the 40% should be in debt market. But this is an old point of view, not currently valid today because the life expectancy has increased. And if you want long-term gains, long-term returns, then only equity is what will give you, not debt. So that should not happen. I think it's more of an individual. If you, today Indian life is about 75, maybe 80 years. So that will not work. So if you feel that you want to invest for long-term, you need research, well, then you should go for equity. Maybe you could have 70-80% in equity and maybe 10-20% in debt. And maybe as you grow older, then you can gradually shift from equity to debt. But that 100 minus age rule no longer applies today. Anything else?
I think everything is covered.
Yes.
There is one question which is asked to me, how beginners can, the amount of money they should put and how do they go about. See, the beginners have to understand how much money they have for next 3 years, which they don't want to take it out. If you want to have a money in between, then don't do anything because you might lose the money. If you're going to block the money, whatever small amount you have, which I also started with a small amount in the past, but if you're going to keep it for 2 or 3 years without disturbing it, then go for it. Even 1 lakh is enough. Sometimes we started with 1 lakh rupees in the past, and then over a period of time you can grow. Opportunities are always going to be there every year. New scripts will be coming, the old script will go, and this kind of rotation is going to happen throughout the life. So whatever amount you put, you see that you don't want to that money for next 1 year, 2, 3 years. Then only you go for it, otherwise don't do it. I think Pritim, that is end of it. Pritam?
I think we've covered most of the questions.
So 1 second. There's one question of invest. Can I take this?
Yeah.
Investing in index ETFs. I'll just tell you that. Okay. I just tell. Is it okay?
Please.
Yeah, okay. There's a question on. I forgot about it. About index funds. Okay. Now, what is an index? Okay. I think you are aware of the Sensex and the Nifty. So Sensex is the Bombay Stock Exchange. 30 scripts together they've chosen and they collectively got a Sensex, and Nifty for 50 shares. Okay. Now you can invest in them directly through a mutual fund. Okay. So you do not go through buying individual scripts. You can buy the index. Okay. This is called as passive investing. So where the fund management fees are much lesser, and you are betting on the index. So it will grow as the index grows. It will crash as the index crashes. The returns are good enough. Okay. So these are the index investing. You can invest in index either directly in the mutual fund. Okay. And second is through your demat account. Okay. Through your stock exchange broker. So through the broker is called as the ETFs, the exchange traded funds, and through the mutual funds directly also. Now, if you go through your broker, then you have to pay brokerage on it. Okay. But if you go directly to mutual fund, then there's no broker you can do direct. This is much cheaper and better. So you can invest in the index also, and you can do it through a mutual fund route, which is better. Okay. Now again, you got large cap index, you got mid cap, small cap, Nifty, Sensex, you've got commodities index, and there are hundreds of indexes available. You can choose whichever you want and you can invest. But so far in India, the index investing picked up by a person called John Bogle in USA, Vanguard Investments. He expired, I think, about 6 months back. Okay. Now, he popularized index investing in the US. In the US, in the last 30, 40 years, passive investing, that is called as index investing, has beaten active direct investing in the mutual funds. While in India, the passive investing so far has not beaten active investing. So in India, I would still prefer going by the schemes on your own, large cap, mid cap, which is giving at least 1 to 2% return as of now, as compared to index investing in India. Maybe the next 4, 5 years, 10 years, when our markets become more mature, we may be like the Western market. But currently, the direct mutual funds schemes are better than the index funds.
There is one thing I'll tell you. Those who are interested in joining the group, it is formed by yesterday, I think they have formed the group which is known as Investing Ideas. And you can join that group, and Dr. Jignesh Tasnawala will help you to join in this group, which we are sharing all the details regularly. So those who want to join, please contact Dr. Jignesh Tasnawala.
There's one question: is demat account mandatory for regular or for direct investment? No. Mutual funds, you don't need a demat account. You can open on your own. While if you go through a demat account, then you will have brokerage. Through a demat account, you will not be able to open a direct account. Your broker, your demat account intermediary will take 1%. So don't do that. You can do it, but don't do it. Mutual funds is direct. And I'll just go about a year back where the Karvi fiasco was there. See, when you invest in a mutual fund, the money goes through the mutual fund AMC. While when you invest into a DAD stocks like RC does, then your stocks, you have given the POA to your broker. So the stocks are in your demat account, but the handling is by your broker, so he can misuse it. While in the mutual funds, the money is not with your broker, with their intermediary, it is with the mutual fund company. So that safety is there. Okay. You don't need a demat account. Please don't go through a demat account, then you will have regular plans. You will lose 1%, which is a big amount of money. Yeah.
I think Jignesh has shared his phone number. Please note that phone number and request him. He will add to that. We have only 38 members now. We can add about 200 more.
So should we conclude?
I think you should conclude.
Yeah,
Yes,
I think it's
yes,
good. Yeah,
yes,
it's been
yes.
very nice.
So thank you all the speakers for enlightening our members with the investment policies, and especially in this COVID times when there is a lot of financial as well as mental stress. I think your guidance will help a lot in soothing the apprehensions of our members. So, and people who have missed this can always access the BOA YouTube channel. They can revisit and re-listen to all these lectures which are put up. And I pass on the baton to Dr.RC Shah for the concluding remarks. So your last words, and then we stop the session.
I think this is the best time to invest. You will never get this opportunity of your lifetime. This valuation of stock exchange and the various shares which is there, they are so low. This is the best time to put the money in stock exchange, either directly or indirectly. Don't put the money in this mutual or a fixed deposit, because the effective return after 40% of tax is not even 3%. Some of the shares are giving dividend which is more than 5 to 7% even today. So I think you should forget about the fixed deposit, take a little risk. Whatever scripts which I have told you, you don't expect more than 10% to go down even if the worst thing happens. And these are the scripts which are going to give you a multiple time returns. I expect 100% per year for next 3 years. So best time to take a risk and invest in stock exchange today. Thank you so much.
Thank you, Mr. Banaji, and thank you, Dr. Manoj, sir.
Thank you everyone for having me.
Yeah,
Thank you. Have a
class,
great
very
evening.
nice. Thank you.
Thank you.
All right. Stay safe, everyone. Bye.
Bye.